Is the Bitcoin 4-year cycle dead? Here's what they're not telling you. Hey everyone. Welcome back to Trade with Unex, your go-to channel for crypto trends, insights, and the truth they don't tell you. Today's topic is going to shake up everything you've known about Bitcoin cycles. We're diving deep into the legendary 4-year Bitcoin cycle, and more importantly, why it may not work anymore. So if you're investing, trading, or just curious, this video is for you. What is the Bitcoin 4-year cycle? First, let's break down what the Bitcoin 4-year cycle is for those who might be new. It all centers around Bitcoins having an event that occurs roughly every 4 years, where the rewards for mining Bitcoin are cut in half. Historically, this halving has created a predictable pattern. Year 1, accumulation. Year 2, bull market. Year 3, crash/bear market. Year 4, recovery/sideways. These cycles happened like clockwork in 2013, 2017, and 2021, leading many to believe Bitcoin is programmed to pump every 4 years. But here's the kicker. What if that's no longer true? The evidence, something's changed. Let's talk about the cracks forming in the theory. In 2021, after the halving in May 2020, we did get a massive pump. Bitcoin hit $69,000. But the bull run didn't look like 2017 or 2013. Instead of one clean parabolic run, 2021 was 2 peaks instead of 1. Interrupted by China's mining ban, pulled back heavily before reclaiming the ADH, followed by a drawn-out bear market that extended well into 2023. And now, in 2024, even after the April halving, Bitcoin has not shown the same explosive price action we expected. Yes, Bitcoin is holding above $60K. Yes, institutions are buying. But where is the parabolic pump everyone was promised? Here's the truth. The game has changed. Why the 4-year cycle may not work anymore. 6 to 12 o'clock. 1. Institutional involvement changed the rules. Bitcoin used to be a retail-driven asset. Retail investors bought in after news, hype, and FOMO kicked in. That's why we had crazy rallies. Now, institutions like BlackRock, Fidelity, ARK Invest are in the game. They're not impulsive buyers. They accumulate quietly, use options, futures, and move with macro conditions. Their strategy is slow and calculated, not driven by hype or halving. 2. Market liquidity and derivatives. Today, the crypto market has matured. We have perpetual futures, ETFs, options trading, leveraged instruments. This added volatility suppression and changes how Bitcoin reacts to halving. In fact, BTC price action is often front-run by traders months before the halving. By the time it arrives, most of the halving pump has been priced in. 3. Macro conditions now matter more than ever. Back in 2013 or 2017, Bitcoin existed in its own bubble. But in 2024, Bitcoin trades like a macro asset. It reacts to US interest rate hikes, Fed balance sheet changes, liquidity in global markets, recession fears. The Federal Reserve now has more influence on BTC than the halving does. If inflation is high or the Fed tightens, BTC might fall, even during a bullish cycle. 4. Halvings are losing impact. Let's face it, the halving reduces miner rewards by 50%, but the actual impact on supply is shrinking. In 2012, 25 BTC, 12.5 BTC. In 2016, 12.5 BTC, 6.25 BTC. In 2020, 6.25 BTC, 3.125 BTC. Now in 2024, 3.125 BTC, 1.5625 BTC. That difference, 1.5 BTC per block, isn't massive when you consider the size of daily trading volume and institutional inflows. So the supply shock effect isn't as dramatic as it once was. What could replace the 4-year cycle? If we're not running on 4-year cycles anymore, then what? Some analysts now talk about 1. The lengthening cycle theory. Each BTC cycle is getting longer due to market maturity, greater capital inflow, slower moving institutional players. So instead of a 4-year pump and dump, we might see 5 or 6-year cycles with longer consolidations and slower growth. 2. The supercycle theory. This is the idea that Bitcoin will eventually decouple from traditional 4-year cycles and enter a long, steady uptrend, like tech stocks did in the early 2000s. Driven by mass adoption, institutional ETFs, sovereign wealth funds, limited supply. But this is theory. We haven't seen it play out yet. 3. Liquidity cycles instead of halving cycles. This is a hot theory. Instead of focusing on halving, watch global liquidity cycles. When central banks are printing, easing, or loosening policy, Bitcoin thrives. When they tighten, Bitcoin suffers. So we may be moving from halving-based cycles to liquidity-based cycles. Why this matters to you? So why should you, the trader or investor, care? Because relying on halving dates alone could wreck your portfolio. The market is no longer predictable using old models. You need to think in terms of macro, liquidity, adoption, and tech development. Stop waiting for magic pumps after every halving. Start paying attention to on-chain data, exchange outflows/inflows, ETF flows, Fed announcements. You need to evolve with the market or risk being left behind. These are my final thoughts. So, is the 4-year Bitcoin cycle completely dead? Not necessarily. It still holds psychological weight. Retail still believes in it, and that belief itself can drive short-term price action. But long-term? It's time we stop treating Bitcoin like a fairy tale. The market has changed, and so must we. Stay smart. Stay sharp. And always do your own research. If you found this video valuable, drop a like, comment your thoughts below. Do you still believe in the 4-year cycle? And don't forget to subscribe to Trade with Unex for more raw, honest crypto insights. Until next time, keep trading smart.